All right, we're back on the halftime report. Shares of Netflix soaring nearly 50% off of their December lows. Now, Buckingham, though, says time to move to the sidelines. They cut the stock to neutral. They do keep the price target at $382, but they say it's not compelling in the current market environment. We've made it our call of the day. It's an interesting note. Doc, I'll come to you on it first. They talk about sensitivity to any market pullback, new competition, and market volatility that's likely to continue relative to China and the trade fight and a whole bunch of other stuff. So is now the time to get out after a 50% jump?
I don't think competition is the reason to get out of it, Judge. That's one of the catalysts here. I don't agree with that one at all, because I think for you to build a critical mass to actually compete with these guys, I'm not going to use the hack phrase moat, but I am going to say that for somebody to build a critical mass that they can sustain, even if it's Disney, I'm going to be shocked if they do it. I know that the parent company of this network, Comcast, is one of those constantly brought up as a potential competitor to these guys. I just don't see it.
Yeah.
If you want to say it's because it's tied to the market and they're sensitive to the direction that the market goes.
Get out. I mean, they don't have a sell on it.
Sure.
Right.
You don't see Amazon Prime being willing to spend billions of dollars every year.
I see them
to make
being
shows
willing
as
to
good as
spend.
Netflix's or better, plus acquiring sports rights. You don't see AT&T now owning HBO and pushing billions of dollars at new content.
No.
You don't see Disney launching in the fourth quarter of this year with every Disney title in history, plus ESPN, plus new shows that don't even exist, based on the most beloved properties all over the world.
This is
going to be the worst year to be Netflix of all time.
So all of those guys you mentioned, Josh, from the Time Warner, HBO,
They've never been this committed.
to
They've never
Disney,
been this committed.
Never been this committed, but they've also never done it before. They've never done it.
HBO over the top streaming app right now. Whoa.
What?
Wrong. There's an HBO app right now. There's an HBO app.
Do you know how many subscribers they have to that app?
Tens of millions.
No.
Yes.
No.
Every HBO subscriber
their burn rate on that thing is incredible.
Mira, if you have HBO as part of your cable package,
right,
you are a de facto subscriber to the over-the-top streaming app.
And more people are dropping that on cable.
One at a time.
Right. With the new ownership of Time Warner, HBO is going to be pushed. Billions of dollars going to be pushed into HBO. They were making like 10 shows a year. Is Netflix ready for HBO to make 50, 100
all over
the world?
Differently. He put it to neutral, guys. So let's look at this a little bit differently. If you own it, the question is, do you sell it?
We're in Game of
And the
Thrones
question is, if you don't own it, do you buy it, right? So they moved it to neutral, right? Neutral.
Can we put up a chart?
No, but the competitive issues are worthy of vigorous debate. Like we're having.
They are.
Look,
they are. I agree with that.
Can we put up a chart?
That's why I pushed back and said no.
But you sound dismissive of the competitive
Who is
headwinds.
HBO going to take market share from? Disney or Netflix? I mean, when these guys, they're going to eat each other. I mean, Netflix just gets to sit back like this, Scott, and let these guys destroy each other because they've got to grab a critical mass. Without a critical mass, they cannot compete with Netflix.
When you're talking about growth, stock trades on subscriber growth, right?
Sure.
So maybe they
international.
Maybe they don't take share from Netflix.
From Netflix, right.
But maybe the new subscriber faced with multiple choices, with AT&T's ability to package it, right, to bundle it, cut prices, with Amazon's ability to cut prices.
And Netflix is raising, and people are still staying there.
That's what I'm saying.
With you. I mean, I don't disagree
but
they're going to build out, but for now,
have gone up incrementally, and that's the issue with all of
And that content cost is the same for those other their competitors.
One at a time, Doc, and that one's me.
Now, soon to be me, so hurry it up.
Okay, I'll get you.
Hurry it up, okay?
The content is gotten more competitive. So the content costs have gone up incrementally, substantially.
I agree.
we have a $395 price target on it, so I'm just saying.
Right. Kate Moore,
yes.
Facebook, Amazon, half the fangs right there. Does the market need the fangs to contribute more?
Well, I think the theme that's coming up here is that there has to be a lot of investment in either content, into sort of new lines of business. Competition is heating up across the world. But we're still really constructive on technology stocks. Look, despite the fact that we've had some weakness in earnings, aggregate earnings expectations are pretty low for the sector in 2019. Some of that is because of the cyclical parts of the sector. And there's a lot of places where we think the recurring revenue is really going to sort of hold through despite any economic uncertainty and any sort of geopolitical risk. So I don't know. We stay constructive. You know, I can't talk individual names on air.
That's why I come to you more broadly on
yes,
tech.
but But I think the investment in content and the investment in future businesses is going to be a major theme. So how companies balance that out against their recurring revenues is huge for the sector.